Hi, and welcome to the course. I'm really glad you're here. You've just taken a big first step towards understanding how the Forex market works and how to trade currencies with structure, clarity, and confidence. This course is built for anyone who wants to learn Forex trading in a clear, practical, and honest way. Whether you're a complete beginner, someone with experience in crypto or stocks, or just curious about how currencies move, you'll find this course breaks it all down step by step. My name is Giles Coughlin, and I've been trading in the market since 2009. I'm a chartered market technician, and I built this course to be exactly what I wish I had when I started. Something that explains not just the theory, but how real traders actually think, react, and how to make decisions in FX markets. Now, you don't need to know economics or be a maths whiz. You don't need to stare at charts all day either. What you need is some curiosity, patience, and a willingness to learn and reflect. If you bring that mindset, this course will help you build the rest. We'll walk through everything from how the Forex market works, to understanding interest rates, macroeconomic data, currency pairs, technical analysis, risk management, and trade psychology. You'll also see real-world trade examples to connect theory with action. Whether your goal is to build a new income stream, understand the world's economy better, or gain a skill you can grow with time, I'm excited to take this journey with you. Let's get started. Before we dive in, let's talk about who this course is for, and just as importantly, who it's not for. This course is designed for people who want to understand how Forex markets work and how to trade it with purpose, discipline, and structure. You don't need a background in finance or experience with trading. You don't need to know what GDP means or follow central bank policy. Not yet, anyway. We'll break it all down, and we'll come to that further down the line. If you've ever thought, I want to understand how currency markets actually work, or I want to learn how traders think, how do professionals make trading decisions, then this course is for you. It's also great for beginners who want to avoid costly mistakes and learn from the ground up. Crypto or stock traders who want to branch into Forex, it's good for them. And just anyone curious about macroeconomics, interest rates, or global markets. People who are tired of noisy signals and want a structured, proven learning path. Now, if you're already an advanced trader or economist, some early lessons may feel basic, but later in the course, we'll go deeper into setups, technical tools, macro themes, and trade psychology, and how to apply this theory in reality. And just so we're clear, this isn't a get-rich-quick course. There aren't any shortcuts here, no overnight success formulas, and there's no hype. What you will find is a full roadmap to building real, repeatable skills, the kind that lead to confidence, clarity, and potential long-term growth. If that sounds like what you're looking for, then you are in the right place. By the end of this course, you'll have a solid understanding of how the Forex market works and how to approach it like a trader, with structure, insight, and risk control. We'll start with the essentials. What Forex is, why currencies move, how interest rates and economic data impact price, and how to understand currency pairs. Then we'll explore technical analysis, chart reading, key levels, candlestick patterns, trend setups, and more, so you can confidently time your entries and exits. You'll learn to manage risk, use tools like stop losses and position sizing, and avoid the most common mistakes new traders make. We'll also explore trading psychology, because in Forex, your mindset is just as important as your method. And finally, we'll look at real trailed examples, so you can see how all the theory comes together in live markets. How the course is structured. The course is divided into focused, step-by-step modules. Each lesson builds on the one before it, so I do recommend you go in order, especially if you're new to Forex. You'll find short videos, practical visuals, real-life examples, and trade breakdowns to make concepts stick. Everything is designed to be easy to follow, whether you're watching at your desk or on the go. Throughout the course, we keep a strong balance between the why and the how. You won't just learn theory, but you'll learn how to use it. So take your time, re-watch bits when needed, you will need to do that, and practice what you learn. Let's get into it. Before we get into the charts, currency pairs, and strategy, I want to share a few tips that can make a big difference in how much you actually take away from this course. This isn't just a series of videos. It's a full roadmap. But how far you go depends on how you use it. The students who get the best results aren't necessarily the fastest learners. They're the ones who show up consistently, stay curious, and keep going even when something doesn't click the first time. In this lesson, I'll walk you through a few simple things you can do to get the most value out of this course. Not just to finish it, but to actually understand and apply what you learn. These tips may seem basic, but they really do separate people who watch trading courses from people who really learn to become traders. Firstly, follow the order. This course was built in a specific sequence. Each lesson builds on the one before it. So even if you already know a bit about trading or economics, it's still important that you start from the beginning. Skipping around might feel faster, but it often leads to gaps. And some of those gaps at the beginning are crucial, that they're not empty. I need to fill them, especially when it comes to macro concepts like interest rates, central banks, and currency fundamentals, and how you apply it in the FX markets. It's important you don't skip that. Secondly, keep notes or a journal. Writing things down help you process what you're learning. The more sentences you use when you're learning, the better and the more likely it is to stick. Whether it's the key ideas, strategy takeaways, or even just your own reactions and thoughts, keeping notes or a trading journal will help you internalize the material faster and more deeply. Thirdly, don't just watch practice. Theory is important, but it's nothing without action. Throughout the course, I recommend free tools that you can use to practice chart reading, explore currency pairs, and even simulate real trades. The more you do, the more everything will stick. Definitely start up and set up a demo account so you can put this into practice. Fourthly, rewatch what you need. Some concepts, right, like policy divergences, sentiment shifts, risk on, risk off, or economic indicators, they might feel overwhelming at first, and that's just completely normal. But don't rush it. You can pause, rewatch, reflect, take your time and let the ideas sink in. When I was first learning these concepts, I'd often return to them over and over again until they became second nature. Now, fifthly, be curious outside the course. Everyone learns differently. If something feels unclear, try exploring it from another angle. Watch a short video from another teacher, have it explained a different way, ask ChatGPT for a simpler explanation, search for a quick definition, or ask in the course question and answer section, and we'll be happy to try to clarify that for you. You're not cheating, right, by looking elsewhere. You're being sensible. You're building understanding. That's what matters. If someone else can put it in a different way that sticks with you, that's good. Sixthly, use the Q&A section. If something's unclear, ask. The Q&A will be checked, and chances are someone else has the same question. It's one of the best ways to deepen your learning and connect with other students in the course. Seventh, aim for progress, not perfection. Trading takes time. You're not expected to master everything on the first go. You'll make mistakes, you'll have questions, and that is part of the journey. The goal isn't to be perfect. It's just to keep learning, keep reflecting, and keep going. That's it for now. If you keep this mindset as you move through the course, everything else should start to fall into place. Now let's dive in to the real world engine behind Forex and see why currencies move the way they do. Forex is the global marketplace where currencies are bought and sold. It's where one currency is exchanged for another, for example, euros for dollars or yen for pounds. This happens 24 hours a day, 5 days a week, across major financial centres like London, New York, Tokyo, and Sydney. Unlike the stock market, Forex has no central exchange. All trading is done over the counter, which means directly between buyers and sellers, usually through online platforms or brokers. Forex isn't just for traders or investors. Every time you travel abroad and convert money, you're participating in the Forex market. Governments, corporations, banks, and even tourists help move trillions of dollars in currency every single day. But traders enter Forex to try and profit from price changes. Let's say you believe the euro will rise against the dollar. You can buy euros today, and if the value goes up, you can then sell them for a profit. These movements happen constantly, influenced by things like interest rates, inflation, global events, and market sentiment. In Forex, currencies are always traded in pairs because you're buying one and selling another. For example, the pair euro-dollar means you're trading the euro against the dollar. If you think the euro will strengthen, you buy the pair. If you think it'll weaken, you sell it. The first currency in the pair is called the base, and the second is the quote. So if euro-dollar equals 110, that means 1 euro equals 1.10 US dollars. You make profits from small changes in these numbers, often using leverage, which we'll explain in another lesson. To sum it up, Forex is where currencies are traded. It's global, fast-moving, and full of opportunity, but it also comes with risk. Before we dive deeper into how to trade currencies, it helps to understand where the Forex market came from. Forex didn't just appear overnight. It evolved over centuries, shaped by empires, wars, politics, and technology. In this lesson, we'll take a quick look at how currency exchange went from gold coins to the $7 trillion a day market that we now have. Let's start in the late 1800s. Back then, most major countries were using the gold standard, meaning their currency was backed by a fixed amount of gold. This made international trade more predictable. If you knew how much gold your currency represented, you could easily calculate its value against another. Fast forward to 1944, towards the end of World War II. The Allies created something called the Bretton Woods system, a global agreement where major currencies were tied to the US dollar, and the US dollar was backed by gold. This gave the world a fixed exchange rate system and made the US dollar the central currency in global trade. But by the 1970s, things changed. The US was under economic pressure and couldn't maintain the gold backing. So in 1971, President Nixon took the US off the gold standard, and the Bretton Woods system collapsed. From that point on, most major currencies became free floating, meaning their values were determined by supply and demand rather than by a fixed peg. This was the birth of the modern Forex market. Currencies started to fluctuate daily. Central banks stepped in to stabilize where needed, and traders, both institutional and individual, saw new opportunities to speculate on those moves. Until the 1990s, Forex trading was mostly limited to big banks, governments, and multinational corporations. But with the rise of the internet, things changed again. Online trading platforms made it possible for individual traders to access the market directly, with live quotes and real-time execution. Spreads dropped, leverage became available, and the Forex market opened up to the public like never before. Today, Forex is the largest financial market in the world, operating 24 hours a day across every time zone. It's a mix of speculation, hedging, and international commerce, all moving at lightning speed. So the next time you see a currency pair change, remember that tiny price movement has a huge history behind it. Welcome to Module 1. We're going to start by diving into a topic that might make some of you nervous at first. It's economics. Now, before you run for the door, hear me out. This isn't the kind of economics that you would have suffered through school. This is something far more useful. We're talking about practical economics, the kind that actually can help you make better trading and investment decisions. So don't worry, it's not as daunting or as hard as it seems at first glance. Now, when you're looking at practical economics, there's a massive difference between textbook economics and the kind of economics that matters to traders. In school or university, you're going to learn theories and models and different equations. And while those, they can be very helpful, they don't always translate well to the markets and the day-to-day trading and investing that people make. And in trading, what really matters is understanding how economic information fits into price action. You could memorize, every single macro theory ever written, but if you can't apply it in real time and you can't translate it into market moves, it won't really help you. But here's the good news. You don't need a PhD or to be a maths genius to apply practical economics. Instead, what you need is a clear and simple framework for understanding what data matters and why. And that's exactly what we're going to give you. So let's start by looking at something simple. Despite the endless stream of data that's released every week, is it the GDP? Is it jobs? Is it the business PMIs? Is it the CPI? Is it retail sales? Is it ZU confidence out of Europe, right? We can group almost all of the data into just two key categories, and this simplifies things and makes it much easier. And those two key categories are growth and inflation. That's the lens we use. So for every new economic data point that comes in, we want to ask one simple question. What does this tell us about growth and or inflation? It could be a payroll report, an inflation reading, or a consumer confidence number. Whatever it is, we're trying to understand, is it pointing towards accelerating growth or slowing growth? Is it pointing to rising inflation or falling inflation? And this mindset doesn't stop at data releases. Monetary policy, fiscal policy, even geopolitical shifts. Think of the tariffs that are taking place at the moment as I'm doing this course. Is this going to result in the US economy expanding and growing or falling? How will the tariffs impact China? How will the tariffs impact Europe? All these questions ultimately influence growth and inflation expectations in some way. So why is it that growth and inflation is such a big deal? It's because they're the foundation of how markets work. Every major asset, is it a stock, bond, currency, or commodity, is impacted by expectations around these two forces. Even very sophisticated portfolio models used by hedge funds and institutions start with growth and inflation as core inputs. They use these to guide asset allocation, their decisions, and adjust exposure to different instruments. Timing and volatility might be layered in too, but the base of the decision comes from these two drivers, growth and inflation. And there's more. Growth and inflation also determine how central banks and governments act. So if growth is too slow, right, or inflation is too high, then government policy has to shift. And that might mean interest rates need to increase, and that's obviously for the central bank to do. They might have to cut interest rates if growth is too slow. They might have to launch stimulus, or they might have to stop stimulus. And when policy changes, markets move, often sharply. Here's something critical for you to be aware of. Not all data is created equal. Just because something shows up on the economic calendar, it doesn't mean it's going to move the market. Some data points matter more than others. For instance, you might have some data points like housing starts or trade balances that only matter in certain environments. And this is where the context becomes extremely important. A minor data release in a quiet week might generate more volatility than usual, especially if it contradicts markets' expectations. At the same time, a usually important release, it could be ignored if it doesn't change the story on growth and inflation. So this is a very important thing to always ask yourself. What is the current context? We will return to this over and over again, and by the end of the course, this will be a simple concept for you. And we're trying to ask ourselves, what is the context that this data point is being released into? And is this going to make a difference? Don't treat the economic data as just isolated numbers. Think about it, how it's fitting into that growth and inflation story, and that will help you to have the right mindset and the right foundation of what to look for. Now, in the lessons ahead, we're going to be walking through real examples of how we interpret economic data and turn it into actionable trade ideas. Don't worry if this first module seems a bit complicated. Just stop thinking of the data as a list of numbers on a calendar and start thinking about what each data point means for growth and inflation, because that's what markets is doing. And when you simplify this noise into this two-point framework, it becomes much easier to stay focused, avoid overreacting, and make better decisions. So next time you see a data release coming up, just ask yourself, how might this reshape the outlook for growth or inflation? And we'll be able to take the foundations of that and build that into a trading strategy. Now, don't worry if that seems a little bit tricky at first, Because actually, it's very simple to find out which data points central banks and governments are focusing on, because they tell us. And they tell us through a variety of different channels, and we can find out what data points they're focusing on, and we can find out how that's likely to impact the market. And there's a number of tools that are available for institutional and retail traders now to make that job a lot easier. So don't worry if the first module seems a little bit tricky. By the end of module 1, you'll begin to have a good grasp of what markets are looking at and how Forex markets move according to this twin movement of growth and inflation.
Economics doesn't have to be boring. Practical economics is about understanding how real-world data moves markets. You don't need a degree, just a clear lens. Growth and inflation. Every data point, from jobs to retail sales, tells us something about growth or inflation. That's your filter. Is the economy speeding up or slowing down? Are prices rising or falling? Everything else is pretty much noise. Growth and inflation shape central bank decisions and market moves. Get a read on these two forces and you'll stay a step ahead of the price. Some reports move markets, others don't, but context is key. A small surprise in a fragile market can trigger big reactions. Ask, does this shift the growth or inflation story?